Hi everyone, and welcome to the InvestSMART Bootcamp Week 3. This module is Module 4, which is Investment Strategies. And I'm Tom Wilson. I'm one of the product specialists here at InvestSMART, and I also look after the bootcamp. So thanks a lot for joining me today. As always, we'll just touch on the disclaimer at the start. Basically, we can't give any specific financial advice. It's always general only. And if I do ever get any questions that come through that I guess are specific in nature to your personal circumstances, I'll either try and rephrase them so that they can be used for everyone, or I might answer them just after the webinar via email usually. Just something that's happening at the moment, and it's one of the reasons why we're so busy here at InvestSMART and Intelligent Investor. We're actually launching our Intelligent Investor Growth Fund. You probably had a lot of emails about this in the last week or two, but it's basically a fund that is actively managed, and we'll touch on this actually throughout this webinar as a good example. And we spoke about active and passive funds last week as well, just slightly in terms of the different investment vehicles you could use. So this fund is listing on the 5th of October. And that means that it will trade on the ASX with a ticker code of IIGF. So at the moment, it's in the period where it's the initial offer is open, and it actually closes tomorrow, the 25th of September at 5 p.m. Sydney time. So it's definitely worth having a look at. It's got a good track record. However, always make your own decisions and whether or not it fits within your time frame goals and your risk profile. But we'll touch on this a bit later as well. So about this webinar, with the GoToWebinar that we're using on the right-hand side, you can actually choose to ask questions. So throughout this webinar, feel free to pop a question in there. We will take questions that are related to the material. It's a really good opportunity for you to ask further about something that maybe doesn't make sense, or if you wanted me to delve into it a bit deeper than what the bootcamp content does talk about. We obviously don't give financial advice, and we need to stick to the course content. So if there's something in there that's not related, I may not answer it. I'll try and bring it back to the content, or I may just answer it after the webinar as well. It's also an opportunity to make sure that you're using all the available resources that we've got in the InvestSMART family of companies, whether that's through Intelligent Investor or Eureka Report as well. And just remember, this is an introductory course. It's just covering the basics. It's not a university course where we'll jump into all different ratios and calculations, or how to price options. That would be in a more advanced course, which we're looking at in the future, particularly in the area of value investing and what Intelligent Investor has to offer. So stay tuned, but that is a work in progress. And as always, we do take questions before the webinar. So when you are signing up to be able to watch the webinars, registering, we actually do allow you to type in a question. We do have a couple in here as well, which is fantastic. So we'll get to them as we cover off the content throughout. So just to recap, week 1, we looked at the first 2 modules, and essentially this is the basis for all of our investment decisions or planning. Need to have a goal, need to know our time frame and understand our risk. Now, I always use the example of myself saving up for a house deposit. That's my goal. I want to have enough so that I can go ahead and approach the bank manager and say, look, I've got this saved. I'm ready to buy a house. What can you lend me? The time frame I've got for that is 3 years. So I've got 3 years in which I'm wanting to save up enough to achieve my goal. The risk is that, well, I don't want something too risky. I don't want to end up going backwards. So I don't want to end up having less than what I started with. That would just be a waste of time, and it would be quite devastating, obviously, with my goal in mind. So that automatically means that it's going to put me into something that's fairly conservative, given the time frame. I'm not going to have anything that's too risky. So how do we go about this? Well, we diversify. So diversification is basically the spreading of risk. You're spreading it across different asset types or classes, different things to invest in. But then we look at asset allocation. Well, that works out, well, what percentage do we actually put into each asset? And that's going to depend on your risk, your time frame as well. Then in week 2, we actually looked at the investment vehicles, all the things that you can invest in to achieve those goals, the diversification, the risk. And we looked at shares and ETFs. So these are securities or investment vehicles that trade usually on an exchange where you can buy and sell. Then you look at managed funds and managed portfolios, which is another way in which to invest. And then we lastly topped off with cash and bonds, so fairly conservative, risk-free assets where technically there's no risk that you won't get your capital back. So if we were to look back and say, what do we actually know so far? We need to have a plan. We know that for sure. We need to understand what we can actually use in terms of investments or asset types in order to complete that plan to achieve it. But we also need to know what the costs are and the risks in doing it, because the costs, they're going to eat away at your ability to get the best compound return that you can, and could put you backwards. I mean, even in my job, I speak to a lot of clients who might be later in their life towards retirement, and they've invested in certain funds or investments or trusted certain people where they managed their investments on their behalf. And it's actually quite sad, because when you hear their story, it's often that they charged very high fees, underperformed, and in some cases, some of these people are actually worse off than where they started. So that's one thing that I particularly don't like hearing, which is why I've got a passion for increasing financial literacy and trying to remove the barriers to understanding good financial knowledge. And what we try and do at InvestSMART is, with Paul Clitheroe, who's our chairman, he's on the financial literacy board for the government. We do have a message where we are trying to change the industry from within and make it more approachable, more trustworthy, more efficient, more affordable. And we do that through the different types of products we offer in our family of companies. First of all, we're going to look at investment strategies for week 3. So this is module 4. It often sounds like one of the most exciting modules, I feel, in this whole bootcamp course, with maybe the investor psychology being a close second. Investment vehicles is always fun too, but it's really interesting because these are just ways in which to understand how best to approach your investment strategy. They're not a complete solution. There's a lot of people out there who've got different opinions as well. A lot of academics also have their opinions on different types of strategies. But this is what we feel is at the core of good financial planning and education. So we'll cover off the difference between active and passive. We'll look at the core and satellite approach. We'll touch on value investing, a little bit of technical analysis, just more explaining what it is as opposed to trying to teach you how to do it. Income, and then strategies based around income. And lastly, we'll look at the perils of market timing. So starting off with active versus passive. Well, passive is basically investing into an index or some kind of security that's just tracking a market. So what you're doing is you're happy to accept the returns of that market as your own. You're not trying to outperform. A great example is if you were to buy the BlackRock ETF that tracks the top 200 shares, it's basically trying to track or replicate the returns that the ASX 200 gives you. If you were to invest in that, what you're saying is that I'm happy to take the returns that that market is giving. I don't want to try and beat it. And I'm happy with the usually lower fees that involves. With an active approach, it's more decision making. you're trying to make decisions that are different to the index, and you're trying to outperform that index or asset class. So a good example could be you might look at the ASX 200 and decide, I don't think that these particular stocks are any good, so I'm only going to invest in 150 of those 200. That would be a form of active investing where you're actually choosing something different from what the index perhaps offers, and you're in control and you're deliberately trying to outperform that market. In our own company, we've got examples, and I'll always use our examples just because I'm more familiar with our products as opposed to others. But if you look at the InvestSMART side, we've got passively managed portfolios. So we talked about managed portfolios last week. It's essentially where the investor owns the underlying assets, such as the shares or the ETFs, but they get InvestSMART to manage them for them. So they do all the buying and selling, dividend reinvestment, tax reporting. Essentially, you can buy a diversified portfolio off the shelf, invest in it, and then it basically attempts to grow your wealth for you by diversifying across different asset classes and with capped fees as well. On the active side, you've got the intelligent investor side of our company, where you've got a team of analysts who spend all their day just researching all these different shares, recommending them. So they post recommendations on the website, but they also have their own portfolios. Now, you've got access to Intelligent Investor and Eureka Report for 1 month as part of Bootcamp. And in fact, I'll show you what I mean. So we're obviously in the process of launching the growth fund. So I go at the top here to Intelligent Investor. I can click on it and it will take me to this website. And like I was saying, there's a whole team of analysts who just research continuously all the different shares on their radar. Okay, so if I were to look at portfolios, these are all the different types of portfolios they offer, and they're all actively managed. So if you're a subscriber and you do have a free 1 month trial that's complimentary to Bootcamp, you can actually see the model portfolios here. So they've got 3 different portfolios that have different kinds of goals. And the first one's to income, trying to get a portfolio that will give you the best kind of income paid to you each year. So looking at dividends and basically any kind of interest that's paid out. One that's focused towards growth, and one is an ethical approach as well. So if you were to look at the growth portfolio, on this website, they'll actually list all of the shares that make up this growth portfolio. So it shows you the allocations on the side here in terms of sector. But then you've got cash. So cash is making up about 15% at the moment. So they're just keeping their powder dry, waiting for opportunities. And then you can see all the different shares that make up, say, the IT sector that they recommend. And if we were to go across to the portfolios again, we can see that you've got, this is the managed portfolios here. We've also got the income that's trading on the ASX under the code INIF, and the share fund, which trades under INES. So the other thing I was mentioning is the growth fund is in the process of getting listed. So that will trade under the code IIGF, and it closes tomorrow afternoon at 5 p.m. But that doesn't mean that you won't be able to buy this in the future. So as of the 5th of October, you can hop onto your brokerage, say Comsec or someone else. You can actually purchase a holding or units in this fund. So it'll trade at a market price. But at the moment, you can actually sign up and get units at $2.50. That's the listing price. And there's no brokerage. So you don't pay brokerage during the initial offerings. It's basically absorbed by Intelligent Investor. But when you do decide to buy in the future through your broker, you will pay them your commission. So basically, because it's an actively managed fund, they tend to charge uncapped fees. So fees that just are based on the size of your investment. It's giving you some performance here. some of the top holdings, which we saw what was in there just before. And there's a lot of videos. Alan Kohler's interviewed Nathan Bell as well. So the InvestSMART website has, under Invest with Us, it has the diversified portfolios. And these are the ones that are passive. So they're not trying to beat the market. They're just happy to get the market returns. And they do that by investing into assets under allocation here. They do it by investing in things like ETFs. And I was talking about the one that tracks the top 200 Aussie shares, so the ASX 200, and that's this one right here. So this proportion of your money would go into something like this, and that's just going to track the return of the ASX 200. So the other thing is, with these passively managed ones that we offer, they actually cap out. So when you invest more than $82,000 across the InvestSMART portfolios, you'll only ever pay $451 per year to us to manage everything for you, which is quite unique in the financial services industry. One approach that a lot of people like to use, and I've spoken to Evan Lucas, who's our Chief Market Strategist, and you can see some of the webinars that we've done within Bootcamp as well, particularly around strategy. And he talks about the core and satellite approach quite a bit. It's a way in which you can, at the core, have a passive type strategy. An example would be one of the InvestSMART diversified portfolios. And that's something that it's at the core that just works away for you. So it's in the background. You don't have to do much with it. You can sort of set and forget, and it's doing its own thing, not trying to do anything special like beat the market, but at the same time, it's following the market returns across different asset classes. And that's basically your core that's working for you all the time. In the satellite that sits around it, and you can have a number of different satellites. They're out there and they're trying to seek outperformance. So they're trying to do better than what the market can. And I spoke to a client recently who is setting up his own, well, actually he was applying for the growth fund that's listing. And he was saying or telling me his strategy in terms of he was looking for something that was actively managed. So he knew that the growth fund that's listing is actively managed. And he explained that he had his core with a number of just passive investments. But on the satellites, he had the growth fund, which he's applied for. And he had a number of other little ETFs there as well. But then he even had a small amount put aside that he uses just for his own personal share trading. So he still enjoys that quite heavily. He uses a lot of the recommendations that the intelligent investor does give, but he finds that keeps him quite sharp, and he tries to outperform or achieve alpha, they call it, in that particular area. Now, when it comes to split, it can be quite subjective, and it depends on what suits you. If you're someone who is, say, later in life and you've got a fairly short time frame, or even if you're someone who's got a short time frame in terms of a goal that you want to realize fairly quickly, you might want to consider putting more weighting towards the core or passive, because that's not trying to outperform. In saying that, you could make a mistake and choose something that's a high risk, such as high growth in core. So you need to make sure that you do understand the timeframes for the passive side as well. So if you're someone who has an overall time frame of only 2 years, but then you put a high growth, which is usually a higher risk, in your core, and you make it, say, 70% of your whole investment, so you do a 70-30 split, then that's maybe not the best idea, because you are choosing a higher risk product. You may want to try and match your time frame to your actual investment type. So value investing, it's one approach to share trading, or it particularly involves around share trading, because it does use a number of ratios that the bootcamp does lead you to, and that's price to book, price earnings ratio, and the dividend yield. And that's really well explained on the Intelligent Investor website. In fact, I'll quickly just take you to where they do have it. Intelligent Investor here at the top. I'll have to go back just to get to their website again. And they basically, under the recommendations here, value investing, they go through what they mean by value investing. They refer you to the different ratios I was talking about before, and how they use them to determine value or whether a particular share is worth a buy or a sell. So this is a very interesting part here, and it does go through it, and it talks about, even with their recommendations, what they mean in terms of what does a buy, hold, sell mean. So we get asked that quite a lot from clients on the phone. They'll say, speculative buy is being recommended. What does that actually mean? And that will explain it there, particularly in good detail. So for example, I just clicked on recommendations latest, and it's going to show me now all of the latest recommendations that intelligent investor analysts have put up. And it's all since 2001, it's been tracked and audited by Ernst & Young. So you can always click there and read the different reports and see how well they've tracked historically. And we've got a question from Sophie, which has come in before the webinar, and it's, isn't value investing just another form of trying to time the market? What are the differences? And that's a fantastic question. What I might do though is I might leave that just to the end where we've got the market timing section, but that's a very good question for sure. So technical analysis is another way in which some investors, particularly traders, so traders, I tend to use that term for people who are a bit more short-term in terms of day traders. They buy and sell perhaps in the same day. They may only hold a position for a day. It tends to be more of traders using leveraged products, which can be inherently risky. But there are a lot of people out there who, for long-term reasons, use technical analysis, and it's basically looking at the prices of a security or an instrument, but when it's put onto a chart, and it does have the ability of showing you long-term trends, but you're essentially looking for patterns, and it does exploit our weakness as human beings, where we look into the sky and we look at the clouds, we might see someone's face, or we might see Jesus in a piece of toast, things like that. Our brains are actually designed to seek out patterns, and that probably has had a evolutionary benefit in the past, but it can be a weakness at the same time for us, particularly with financial investing. What I've found, so one of my previous jobs was working in a brokerage company where we had a lot of people who were doing technical analysis. A lot of the strategies tended to be quite cyclical. So they would suit a certain part of, I guess, the market in terms of if it was a bull market or trending sideways, so nothing happening in terms of price, or just going down. So a lot of these strategies would work for them, but they're usually time specific. What I'll show you is there's a website that I like to look at myself. I find the idea of technical analysis interesting. I don't think I'm a convert, but I would always use charts to have a look at the price because I just find it easier. I like looking at pictures myself as opposed to sitting there and reading a lot of data, but then that's me. So it's a website called tradingview.com, and you can basically, at the top here, type in the different tickers, the different stock codes or index code. I've typed in XJO, which is showing me the Australia 200 or the ASX 200, so the top 200 shares. And what I can do is, I mean, here it's showing us basically the price in terms of the index price, which is 5870 there. I can click on the full featured chart. And in terms of technical analysis, what people are doing is they're looking for symbols, looking for patterns. So one of the easiest ones is if we try to look at a thing called a trend line, I can come over here and just draw a trend line. Now, a trend line usually works by the lowest low to the second lowest low, which is here. Now, what that means is I can extend this one out and it's still only touching there. But for example, It's touched it once, it's gone up, and each candle here is showing you a 1 month of pricing. So each little candlestick, they call it, is 1 month of pricing from open to close. So it's showing us that it's gone up, it's come back down, it's touched this trend line. Now I just drew that there myself. And then as it's progressed, it's not really touched it again, but it's moved up, obviously in a upwards fashion. And then we've had this drop here back in March, and it's come a little bit close to it, but then it's obviously trended back up. Now, I mean, you might get some people who would look at this and say, I'm waiting for a third touch of this support line, because I know that when it touches it again, it's either going to break through it and keep going down, or it's going to keep going up. And that can sound quite, to a lot of people, they can think this is the holy grail, and there's so many different other types of technical analysis tools that people use, such as Fibonacci type sequencing. There actually, a lot of them are on the side here. Pitchfork. It can get quite complicated. A lot of the technical analyst traders that I used to know or still know, they'll only ever use maybe a maximum of 1 to 2 of these tools on the chart. So they'll draw their trend lines, and then they'll do perhaps something like this relative strength index here. And they'll use that to try and make decisions on when to enter and exit trades. But the problem is that, I mean, I just drew that. This is showing you going back in the past. You could easily draw a line from there to there, which perhaps would connect. Then what would it do in the future? It's a good tool just to have a look at long term. Like, I like looking at charts because I can sit here now and say, okay, it looks like obviously on a month by month basis, the ASX is showing that it's rising. It's had some big peaks, obviously back in 2007, and then some lows in 2009 because of the GFC. I just like the graphical interface that it shows me. But yeah, one thing is you should always just be aware of a lot of people trying to sell you their strategies or their kind of tools to do this. I mean, I could turn around and say, I've got the tools to draw trend lines. You could use this as a way to buy and sell different assets. But the problem is that you need to have a track record and show them back testing. A lot of people can sometimes fake that. So always just be very, very careful and suspicious when it comes to people trying to sell you trading systems. And that's the last point there is, beware of the traders selling their technical analysis or bots. I'm going to skip to the next one here. So yeah, that's TradingView there. There are some interesting articles they post as well where people talk about different other tools, and it gives you an oversight of different markets that you can follow. So it's worth a look. I guess you don't have too much noise though when you're trying to invest. So in terms of income, when we talk about income, obviously we, as workers, we all earn income from our jobs if you're lucky enough to have a job. Otherwise, we also refer to it in terms of investing as dividends received, interest that's paid to you, but sometimes other things as rent or tolls. So if you invest in, say, a toll company, they may pay you the portion of the tolls as a form of income. So depending on how you view income is completely dependent on your stage of life. There's a lot of people who enter the retirement phase and they are seeking out assets that will pay income to them, particularly if they offer some kind of franking credit that can have tax advantages, which I can't touch into myself, but there are some articles on Bootcamp and also on Eureka Report too. That will probably lead us to the bucket strategy in terms of how it works. It's basically 3 buckets, and I know we do go through this on the Bootcamp as well, but essentially bucket 1 is having or is full of your, I guess, current cash, your liquid cash for spending that you're doing right now or for the next 2 or 3 years. So in the second bucket though, you've got additional income that's being earned from the dividends and interest, which we were talking about before. And that's earned by investing in diversified portfolios of investments that I guess tend to have a balanced profile. So straight away, you can see that the current spending, which is the first one, is cash, which is defensive. The second is saying you want to have like a balanced profile that's paying out dividends and interest, as well as growing in capital growth, so going up in value. Then the last bucket there is going to be a growth type approach, or growth bucket. So this is where you would invest in, say, different portfolios that have a higher growth focus. So they're trying to increase their capital gains in terms of going up in value. So the other thing is all the top-ups will flow to the cash flow bucket, and any income from the cash flow bucket can flow to the current spending. This is a strategy that's been dreamt up in terms of trying to make it easier for people to understand. I guess even trying to create a system where you can get around some of the limitations that I guess as investors we can come up against. It's trying to basically take advantage or try and stop you from going out there and just putting all your money into one little thing that could be not diversified or could be quite risky. By doing it this way, it's trying to show you how you can have a percentage that is defensive, a percentage that is balanced, and a percentage that is growth, and how they feed into each other. If you were to have to summarize all this, it essentially falls that it's a balanced portfolio, because you've got sections in defensive assets, diversified, and there's a touch of growth there as well, so that you're trying to grow your portfolio at the same time. There's the webinar that Evan Lucas and I did on strategy, which is in the bootcamp modules as well. He does talk about this in a lot more detail. And Nathan Bell, who's the head of research and the fund manager for Intelligent Investor, he talks about this as well. And he actually even gets asked quite a lot about questions from like even his father, who's older than he is, obviously, but in that stage of his life where should he be just investing in completely conservative or defensive assets. And Nathan is obviously from the active side of the business. He sort of said to his father, you should still have, dip a toe into the active area, so that will give you the growth, but obviously not too much at your stage of life. So market timing, this is one that we get asked about a lot, and not directly. It's usually when we talk to investors or even just people who will ring up and want to chat about the market. And it turns out a lot of their problems center around this. So going back to that question that Sophie was talking about before, she was asking, isn't value investing just another form of trying to time the market? What are the differences? So market timing, it's basically the problem that we all have as human beings. We're terrible at choosing when to get in and out of particular investments, particularly shares. A lot of the experts themselves, a lot of the time they don't even know. That's why they sometimes won't go out there and, some do sit there and say, look, the market's going to go up, it's going to go down, this is what's going to happen. If you were to go through and check which ones are consistently right, you'd probably find it's a very, very low, if at all, number. And this is particularly in the short term as well. So in terms of Sophie's question, I guess value investing in the sense, as any kind of strategy that we've even spoken about today, it is a market timing type issue. A lot of the market timing does fall around short-term timeframes. A good example could be this year when we had the COVID pandemic strike us in March. We saw the market drop quite considerably, and even we had investors who were invested for the long term in products that do say you should have a 5 to 7 minimum time frame outlook on this kind of product. But they only just started to invest and they saw their investments drop by up to 30% in some cases, which is scary. There's no way you can say that's not scary. When asked about this, we would always say, okay, it is something that's not good, but long term, you can expect that it should return eventually to where it was, or if not even trend higher. And it comes down to, obviously, there's that fear, there's that greed as well, which we'll touch on in the next webinar. But it comes back down again to what your goals are. So if you are someone who does have a long-term time frame, such as a lot of us who say are mid-30s or even 40s, and we're invested in super, we've got the time before we retire to ride out these kind of things. We can ride out the ups and downs. So therefore, if we aren't invested in something that does have a higher growth and essentially a higher risk, we may be missing out on some of the returns that people the same age of us are invested in. So value investing, to come back to that again, sure, it is like a way in which to try and, I guess, read the market and, in a sense, time. But if you look back to the Intelligent Investor and how they describe it, they're using a lot of different ratios. So they're actually going through all the different companies, going through all their books and spreadsheets, and they're trying to find out if this company is worth less than the price it's trading at on the market. So it's a slightly different approach to market timing in a sense, because they're looking at undervalued or looking out for undervalued shares. It's also very long term. They talk about buying a share or a company that they think is undervalued, and they're willing and able to give it the 5+, 7+ years that it might take in order for it to reach a certain point of value. Now, the market is inherently irrational. You see the prices of different shares fluctuate daily, and sometimes for no good reason. They try and look through that noise, and in a sense, they're in it for the long term. But if the price does rise quite quickly and it represents a chance for them to get out at a good profit, well, then they might take that because the market's mispricing, and they'll take advantage of that. In terms of the market timing problem that we usually see with longer term investors who perhaps do have that fear when their investments drop in value, what we see is they will call us and say, the market's down 10%, I'm going to get out and I'll wait. I'll wait until it goes back up and then I'll jump back in. And one of the first questions we'll say is, okay, how do you know when it will go back up? And no one knows. No one knows the answer to that. So what tends to happen is you'll get the unfortunate person who will exit at the very bottom. So they've ridden out that whole drop down at the very bottom. Then it'll start to go back up as it has in the last number of months since March, and then they'll buy back at the top again. So all they've managed to do is, instead of just waiting out in terms of their goals, their time frame that they originally had gone with, all they've done is managed to realize or crystallize a loss. So they will definitely lose that chunk of money. And it comes back again to, if you've got a plan in terms of your goals, your time frame, and your risk, it's something that you should follow and stick to. You can change it as you go through. We did talk about this in the investment planning module and webinar. But ultimately, you need to stick to your time frame and what your plan has actually told you to do as well. The other way you can get in and out of some of these issues, like there's a lot of clients on the flip side who were very happy to invest because they saw the market drop off, and to them, this represented value. They said, this is temporary. The shares or the market itself is representing great value at the moment because they're all underpriced. I'm going to jump in. And some clients will have very large sums. So instead of jumping in all at once, they'll do a thing called dollar cost averaging, where they'll split up their investment amount into smaller chunks, and do it over a course of days, or even hours sometimes, or weeks, and they'll put in bit by bit. So eventually their entry price will average out. So they won't have to stress too much about today the market was up, tomorrow it was down, which day do I decide to do it? Trying to do that is market timing, and it's not the best way to approach it. So we've reached the end of this particular module, and it's definitely open for questions still. And there was one that Pamela submitted before this webinar, and she was asking, are Australian companies that sell to or operate in an international market a substitute for international shares? And that's a really good question, because throughout this entire course, particularly in the last webinar, we looked at diversification. And as part of that, we look at having Australian shares, but also having some exposure to international shares. So that's a good question. And there's a really great way to answer it. And what I'll do is I'll just jump back to the InvestSMART website. We've got this really cool tool at the top called the Portfolio Manager. And if you click on it, it'll take you into it. And you'll actually see this is the portfolio. It's a hypothetical paper trade that my colleagues and I, each year we have a competition where we have a certain amount of money to invest. We put $1,000 in each letter of the alphabet, but it means that we have to choose a security that starts with the letter A right to the letter Z. And these are all Australian traded holdings that I've got, but you can see that here I've actually got a percentage, 10%, which is towards international equities. And how that is that some companies, particularly ResMed, is a good example, which I do have a holding of here. They have a proponent of their revenue, which is overseas based. So that does count towards international exposure. So to answer your question, Pamela, while they may not be a substitute completely, they could be a percentage. So ResMed might have 30% of its revenue come from overseas. So effectively, in a way, that is a form of diversification. If you type in all the different holdings that you might have into this portfolio manager, it'll actually automatically assign percentages of companies that it knows that have overseas exposure or revenue and do it for you. You can actually even change that. And when enough users change that themselves, this is smart enough to realize that a lot more people are doing it, and it'll actually change it for everyone else at the same time. So that's a really great question. Definitely ask any more questions as we're going. Otherwise, we'll look to finish this up soon. And you can always ask questions post this webinar by emailing bootcamp@investsmart.com.au. We're a little bit slow at the moment with getting back, just because we're concentrating on the growth fund, the initial offer, just trying to get as many people signed up and applied in the short time frame. So that's the focus just at the moment. But if you do email, I'll definitely have a look at it and try and get back to you maybe next week, unfortunately. But apart from that, thanks so much for your time. And if you have any questions or feedback, definitely pop them through, but I'll leave it with you until next week.